This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Saretsky here. Welcome back to the show. Lots to touch on this week. We've got GDP statistics here in Canada. We've got a rate hike announcement, or no rate hike, I should say, from the Bank of Canada coming up June 7th, as well as what's happening sort of feet on the ground in the residential construction market, how I see that sort of filtering through and layering that over with some of your population statistics and what governments are trying to do, which is get more supply to market, and why I think that's going to be a challenge moving forward, despite some pretty big policy changes that are happening. But to sort of frame up this week's video, you had Canada's GDP growth surprised to the upside in Q1. Surge, moving past 3% on an annualized basis. It is important to note on that GDP figure that the bulk of the growth actually came in January, and GDP growth was very, very stagnant in February, March. But despite that, it's actually ahead of the Bank of Canada's own projections. The Bank of Canada was projecting, I think, 2.5% annualized growth in the first quarter. We were about 3.1. So again, if you're the Bank of Canada, you're saying, well, hey guys, we raised rates, 425 basis points, and housing market's starting to sort of take off again, and we've got growth that's coming in stronger than forecasted. I think there's an argument to be made that maybe, just maybe, the Bank of Canada could and maybe should be considering another rate hike. Not only at this meeting coming up on June 7th, but we've got another one coming on July the 12th. The markets right now, again, markets will price rates from the Bank of Canada every week. And so these are constantly moving targets. But if you look at where the OIS is right now, overnight interest swaps, basically, projecting 12 months out, they have the Bank of Canada overnight rate at 4.86%. So basically what it's saying is they think 12 months from now, the Bank of Canada is going to have rates between 25 and 50 basis points higher than where they are today, this time next year. And so, I mean, personally, I disagree with that. What you will see, now keep in mind, is you're going to see markets reprice, right? So you could get some really bad economic news that comes out, 3 weeks from now, 2 months from now, and that will automatically reprice. Now, remember, about a month or two ago, markets were pricing in a cut from the BOC this year. Again, now they're projecting higher rates 12 months out. So you can see this sort of the volatility that we have in interest rates. And so if you imagine this volatility that's happening right now, you can imagine what it's doing to real estate developers or people that obviously invest in these developments, right? Developers have to raise private equity a lot of times, private capital to fund a lot of these development projects. And so when you've got this volatility in interest rates, it becomes extremely difficult to put money to work, right? I mean, real estate is a highly levered, capital-intensive business, and so not having a great clarity on the stability of interest rates, right? When we went from 0 to 4.5 in like 12 months, we went on pause. Now people are talking about Bank of Canada having to raise rates again. And so it's becoming extremely hard for developers. So what you're seeing them is they're actually pulling back on projects. We've gone on video here, several months ago, but one of the larger developers, I wouldn't say one of the larger ones, but decent sized developer in Vancouver blowing up. We've got another one here, making the headlines this week, Thin Developments returning. So now they were able to pre-sell the project, but they're actually returning the 20% deposits to all their pre-sale buyers because the project, I think the margins are ultimately too tight with the surge in interest rates. At least that's what they're blaming. And I think, based on my conversations with people in the industry that are actively developing, the numbers are tight. I mean, I was running a pro forma this week for a rental project. It just the interest rate makes up such a large component of your pro forma. So when you're projecting returns, when you're putting that interest rate into your spreadsheet, going from long-term debt at 3.5 to 4.5 makes a substantial difference on your returns on that pro forma. And so again, when you're taking the new updated spreadsheet to your investors, they're going, well, those returns are really tight and a lot of things have to go right for this to work. Given the risk reward environment that's out there, I'm just going to stick my money into a GIC at 4.5%, and I'm going to sit here and wait till I get a little bit more clarity 12 to 18 months from now. And so that's kind of what's happening at scale, which is interesting because, you look at the most recent Q1 data for this country. We added just under 150,000 new permanent residents, which was the most on record, just under 150,000 permanent residents. So you got all of these people coming into the country. The rental market's incredibly tight. The resale market's going back up, low inventory, no listings. And you continue to funnel. Like, remember, last year in 2022, we added 1 million people into this country, and you got more of the same projecting here through Q1 of this year. That supply is actually starting to come off the market. Now, I will caveat that with saying that, yes, in a prolonged, deeper recession, you will see a drop-off in non-permanent residents, which is essentially temporary workers, right? I mean, if the labor market starts to stink, obviously you don't come here for a job, you just don't come into the country at all. So you'll see that non-permanent resident growth pull back. But in general, even through the late 80s, you still had population and immigration growth in this country, despite obviously a fairly sharp recession. So you'll still have the population in this country growing. It just won't grow at 1 million people a year if you obviously have a recession. But the sort of short answer here is that housing supply is going to fall off. It's going to fall. We're seeing now a lot of developers trying to take projects they tried to pre-sale, trying to convert them to rental because they need to keep sort of the wheels churning. So a lot of people are pivoting right now, and a lot of people are simply just, if they're able to, some projects are not able to. If they're able to, they'll just hit pause and leave the dirt alone and sit on the dirt for another 3 or 4 years and talk about launching when market conditions improve. But those that have to move forward because they've got investors pushing them into the project, and obviously you have a time decay of money, right? The longer that the project sits idle, the lower your returns, compounded over 4, 5, 6 years, et cetera, over the life of the project. So there is a cohort of developers that have to push forward, and I can tell you a lot of these developments, everybody always puts these analogies out that the developers are making boatloads of money. Look at a lot of these pro formas. A lot of these developers aren't making anything. They're collecting their development fees, but the investors are getting squeezed and the developers aren't having really any lift on a lot of these projects. So it's an interesting dynamic that, and this is kind of comes back to my whole kind of point, is I think that there's a decent probability the Bank of Canada could potentially squeeze out another rate hike. It's not my base case, because I look at it fundamentally from the housing market being one of the largest components in this country, and I'm still extremely skeptical. If housing start rolling over, just the proportion of that GDP that's going to shrink, I think is significant enough to have a drag. And now again, keep in mind, we talked about this in the last week's show, 1/3 of all mortgages in Canada haven't actually seen a payment increase. So the reality is a lot of these interest rates haven't actually filtered through. So I just think it's just only a matter of time. Rates at these levels, housing starts to roll off. That is going to create longer term issues. The ironic thing is that governments are trying to incentivize more housing supply, right? We've tried foreign buyer taxes, we tried foreign buyer bans, we tried empty homes taxes, we tried speculation taxes, we tried increased property transfer taxes. We've tried all these demand side measures, and it hasn't really done a whole lot for the average person in terms of affordability. And so now they're actively saying, okay, well, maybe we start looking at the supply side. So how do you get the supply side active, especially in an environment where interest rates are up significantly, cost of construction still elevated, housing supply naturally is going to roll over on its own. And so if a government wants to be counter-cyclical to that, well, they could start by looking at their own sort of profit books, which is government government fees as a proportion of the development. So there's a great chart here, highlighting the amount that these governments are charging. Remember, on a project in Ontario, roughly 30, I believe it's close to 30% of the price of a unit that's going to be sold for sale is actually just taxes. So taxes and government fees make it a very, very large proportion of that. So if you're a government, you look at the BC government that came out and said, hey, we're going to allow duplexes, triplexes, fourplexes on the vast majority of all land in BC. We're going to remove single family sort of zoning and allow multiplexes. But if you actually sit there and you run the numbers on these multiplex units, the numbers don't really pencil. If I was a developer taking a piece of land, chopping it up and building 4 units on it and trying to resell it, the margins are razor thin. And again, it's all about the risk reward in a market where there's a lot of volatility, particularly in interest rates in particular, which is one of your larger expenses. And so it's hard to deploy capital in that market. So governments are going to have to be counter-cyclical if they want housing supply to continue to grow. And again, I don't think that's going to be the case. I just don't think at the end of the day, the private markets, the capital markets, I think naturally are going to pull back on their own. We're already seeing that happen. And so it does set up an interesting dynamic, 3, 4, 5 years down the road, because when housing starts to slow down, they don't just start picking back up a month or two from now. These are long, intensive projects that take time to basically plan out and start to deploy. So bringing all that together, again, we've got a Bank of Canada rate hike announcement coming up on June 7th. Another one followed up in July the 12th. I still am personally saying I don't think they're going to raise rates. You can come here and comment on the YouTube below when they do and rub it in my face. But I still think it's going to be a mistake. I think that housing is not quite as strong. Yes, we've had a very strong spring market on the backs of 20-year lows and new listings, but overall volume still relatively benign. And you've got housing starts, which is a very large component of GDP, rolling over and will continue to roll over given where interest rates are. We all know the carnage that's playing out in the office space as well. So, like I said, these things take time, and this is something that I'm watching. So if you're looking and hoping and have aspirations on the housing supply front, I don't think it's going to improve materially over the next 5 years. So waiting, watching, and we'll see you next week.